Now, let me say something specific about some of these Eurozone countries, because, as I said, we spoke about some of the general problems and some of the general solutions, but then you have to speak about the specific. And as I pointed out, each one of these countries in the periphery has different problems. Let me start with Greece. In my view, in the case of Greece, the issue at this point is not anymore of whether an orderly restructuring of their public debt is going to occur. It's not a matter of if or whether, but rather when and how. Even if Greece were to implement fully the IMF EU program, that is a draconian 10% of GDP reduction of its budget deficit, in 2 years from now, in the best scenario, the public debt of Greece is going to be 150% of GDP. Best scenario. In other scenarios, it could be 160 or 170. That's not a level that is stable, because any shock can lead to a disorderly debt dynamics, and that's not a level of illiquidity. That's a level that historically, by any standard, implies insolvency. Just to give you a parameter, Argentina and Russia defaulted on their public debt when it was 50% of GDP. In the best scenario, in the case of Greece, it's going to be 3 times as much, 150% of GDP. Greece tried Plan A, that was the plan that says, we provide you money, you do fiscal austerity and reform, and conditional on that, you're going to restore your market access, and you're going to be restoring your viability. Plan A, unfortunately, has not worked. Greece next year in the IMF program is supposed to go back to the market and borrow in the private market 40 billion euro. Chances that that happens, according to Greek officials, are 0. So either the official community decides to augment the IMF program by another 40 billion next year, another 40 billion next year, and eventually take over the entire public debt of Greece and finance forever its budget deficit, unless the international community is willing to do that. And in my view, that's not a good idea, implies a lot of moral hazard. The only viable alternative is going to be an orderly, market-oriented restructure of its debt. As I pointed out, you don't need debt reduction. You can push the maturities out. You can cap the interest rate on the debt below market rates. You can keep the face value of the debt at 100 cents on the euro, so that banks, insurance companies, pension funds do not have to write down the debt. That was what's done in the Brady plan with the power bonds. That was done in a number of emerging markets. That solution is viable, is feasible, could contain contagion. Unfortunately, that solution is going to be implemented in the next 6 to 12 months, and that's necessary and avoidable. Second issue is Ireland. Ireland is a different story, because Ireland started, unlike Greece, with a private debt problem. You had the housing bubble. The public debt and deficit was low, while in Greece was high, the public deficit, even before the crisis. The problem of Ireland derived from the fact that the bust of housing, that was the biggest bubble ever, has led to massive losses for the banks. The losses of the banks have been socialized, and the public debt of Ireland last year alone went from 70% of GDP to 100. And 2/3 of that increase in debt was putting on the balance sheet of the government the losses of the banks. This year, the hole in the banks is even bigger. The debt is going to go to 110% of GDP, 120, and more so. So the trouble with Ireland is the following one. Ireland so far has decided not to bail in and force the creditor of the banks, not the depositors that are guaranteed, but the other senior bondholders of the banks, to take a loss. And instead has decided to put on the balance sheet of the government all of the losses of the banking system. But think of it. If you socialize all the private losses and you put them on the balance sheet and the bank on the back of the government, eventually the burden of that debt on the back of the government is going to crack the back of that government. That government is going to break, is going to have a sovereign debt crisis, and once a sovereign debt crisis occurs, the ability of the government to backstop its own banks is going to fail. So the rational thing to do in the case of Ireland is not to shove all these losses in the private sector on the public sector, but to have an orderly restructuring of the senior, both the senior guaranteed and unguaranteed debt of the banks. If you don't do that, 2 or 3 years from now, you're going to have a public debt problem that's unsustainable, and like in the case of Greece, you're going to have a sovereign restructuring. So far, the Irish, under pressure from the European ECB, have decided not to bail in the private creditors of the bank. In my view, that's a mistake. The banking risk, as I pointed out, has become sovereign risk, but since the banks hold the public debt, eventually the sovereign risk is going to become a banking risk if you're going to have a sovereign debt crisis. Let me speak briefly about Portugal. That is a country we are here today. I think that Portugal has a chance, if it implements the IMF and the EU program, that is painful fiscal austerity and structural reform, of gradually restoring its competitiveness, gradually restoring its economic growth, gradually reducing the stock of private debt and public debt and deficit. It's going to be painful, but is necessary and has to be done. And whoever is going to be in power, and this is a great democracy, and in June this country is going to decide who's going to run this country, there is no option but trying to do it. And the positive is that all the parties in this country so far have committed to a very painful process. It's going to be painful. It's going to be implying sacrifices for all. Of course, there are uncertainties. There are uncertainties, one, because we don't know who's going to be elected. We don't know whether that government is going to have a majority and able to do the tough choices. We don't know whether that program is going to be implemented in full or not, and how much social and political resistance is going to be. And we don't even know whether, even if it's fully implemented, whether output is going to recover fast enough, or whether fiscal austerity and the reform are going to imply a continued recession that eventually is going to become economically and fiscally and financially unsustainable. So there are these uncertainties, but I think that trying plan A, trying to commit to it and work hard to try to implement it is the best choice that the country has. I hope that they do it. I hope they implement it. If that happens, and that restructuring can and should be avoided. If the plan is not implemented, or if it's implemented and the collateral damage to the real economy turns out to be worse than expected, then down the line, 2 or 3 years from now, the necessity of a debt restructuring could become a reality. It's not my favorite choice. I would not recommend it to Greece. I would not recommend it to any country, but the choice is in the hand of this country to try to do their best to avoid a painful adjustment of a different sort. So that's an open issue. Let me say something about Spain. Spain, unlike Greece, Ireland, and Portugal, so far has not lost market access. And certainly the markets today are pricing the debt of Spain as if it's different from the other 3 countries that so far have lost market access and required an IMF-EU bailout program. There are a number of dimensions in which in Spain things are better than the other countries. The budget deficit is lower as a share of GDP. The public debt is lower as a share of GDP. The savings rates of the country is higher. And they've done more fiscal and other reforms that go in the right direction. Those are the positives. Those are the reasons why the markets are hopeful today that Spain is not going to fall off the cliff. And Spain, by the way, on one side is too big to fail, but also too big to be saved, because it's one of the 4 largest economies of the Eurozone. So if Spain were to lose market access, the contagious effects will be certainly more significant than other countries. There are, however, a number of dimensions in which in Spain things are highly difficult. The unemployment rate in Spain today is 20%. Among the young people is 40%. In Greece, unquote, is only 13%. In Spain, like in Ireland, you had a huge real estate bubble and boom went bust, and the collateral damage to the real economy of that bust is still ongoing. Home prices in Spain officially have fallen only 11%. In Ireland, already fallen almost 40%. If they fall 40% in Spain as they do in Ireland, the damage to the economy and to the household sector and the defaults are going to be significant. The recession could last longer than otherwise. 3, like in the case of Ireland, the losses of the banking system in Spain could turn out to be larger than what the government is currently expecting. If the larger losses will be to materialize, putting them on the balance sheet of the government is going to make the public debt more significant. 4, in the boom years where you had a real estate bubble, everything looked like great in Spain. Wages were growing like crazy, much more than productivity, and the rise in unit labor cost was as bad as in Ireland. Now we knew that the emperor was naked, that a lot of that growth was artificial, and now that the tide has receded, we know who was swimming naked. Unfortunately, that has happened. It's going to take painful reforms to restore the productivity and the competitiveness in Spain that has been lost for these years. So we do hope that Spain does not lose its market access. There are many positives in the direction it's taking. There are also many negatives in which the country is weaker than other members of the Eurozone. The jury is still out on that. Final point on the rest of the Eurozone, I would say no country can be complacent. countries like Italy, countries like Belgium, even countries like France have to do structural reforms, have to do fiscal austerity. As we know, when markets become nervous about you, in a matter of days, your interest rate, your spread can go to the roof, you can lose market access. So this is not the time for the Eurozone to be complacent. Everybody in the Eurozone has to do the right things, and it's not just the Eurozone. As I pointed out, the United States, United Kingdom, Japan, most advanced economies have a serious problem in terms of budget deficits, in terms of private debt, in terms of the structural reform we need to do. In the US, we have to invest into infrastructure, into education, in better healthcare, in providing our workers with the skills that are required to compete in this global economy where China, India, Asia, Latin America, and others are emerging. So that's a challenge that all advanced economies are facing. As I said, the bond vigilantes have woken up today in the periphery of the Eurozone. Tomorrow, you could have a bond market revolt, even in the United States or Japan. Let me make also now some final consideration about addressing this financial crisis. We started, as I pointed out at the beginning, this financial crisis with too much private debt, households, financial institutions, corporate sector. And when the crisis occurred and the bust occurred, we pretended that in some of these episodes, these were problems of liquidity rather than problems of solvency, and we decided to socialize these losses, and we put them on the balance sheet of the government. So we started with a lot of private debt, and now we ended up with a lot of public debt, assuming that this was just a short-term liquidity problem. In some cases, some governments that have so much debt and deficits have already lost now market access. They've lost market access in Greece first, in Ireland, now in Portugal. And there is a risk of loss of that market access in the future in Spain and other countries. So as this government lost market access, again, we've pretended that some of these problems are problems of liquidity rather than solvency, and therefore we've provided now supranational authorities the resources to lend to these national governments to bail them out. So we started with private debt, now we had public debt, now we have supranational debt. The IMF, the ECB, the EFSF, the EU, in 2013, the ESM, and so on. Now, as you think about it, we have kicking the can down the road. We started with private debt, now public debt, now supranational debt. First observation, no one is going to come from Mars or the moon to bail out the IMF or the ECB, right? So there is this much you can kick the can down the road. We're reaching already the end of the road, and as you kick this can, it's becoming bigger and heavier. So at some point, the debt can cannot just be kicked. You have to resolve it one way or another. So that's one point that we do recognize. And as I said, if growth or inflation or savings are not going to resolve this big debt can, eventually you have to shrink the can by reducing debt and restructure them in order to that happening. Broader point. There's a broader issue about the future of the European Union and the future of the Eurozone. The current approach has been muddled through. Believe that these are only liquidity problems, that provision of liquidity together with reform and fiscal austerity is going to turn a liquidity problem into something you can solve rather than having a solvency problem. But this current approach that is muddled through, that is extend and pretend, lend and pray and delay, is not working in some of these cases and might not work in some of these cases. And therefore, the current approach, in my view, is not a stable equilibrium muddled through, is not even an unstable equilibrium, is an unstable disequilibrium. Therefore, either the Eurozone is going to go in the direction of greater union, political union, fiscal federalism, or things of that sort, or if it's going to not go in that direction, something along the lines of more disorderly defaults, and down the line, I don't predict it this year or next year, but if these problems are not resolved, things that are unthinkable this year, 5 years from now, like some economies deciding to exit the monetary union, things that today nobody's even thinking about, could become thinkable. And certainly in the next year or so, orderly restructuring of debt not only are thinkable, but they are necessary and unavoidable. So muddled through doesn't work. Either you go to greater fiscal and political union, or otherwise you're going to go to something that's going to be more disorderly in the direction of a breakup of the monetary union down the line. So that's the situation that is right now. And the politics in the Eurozone, in many ways, is becoming worse. Because of the results of the German election, because of the results of the Finnish election, because of things that are happening in countries like Slovakia or Austria, many of these creditor countries are saying, why should I bail out the Greeks, the Irish, or the Portuguese? There is already a political backlash against these bailouts. And whether we like it or not, that unfortunately is happening. Of course, you can make the argument that the bailout of Greece was not a bailout of Greece, but the bailout of the creditors of Greece, that is German or French bank. And you can certainly make the argument that the Eurozone has been highly beneficial to Germany because the stability of a monetary union, of no movements of currencies, of free trade in movements of capital, in labor, in goods and services, has been highly beneficial to the growth rate of Germany. But while the German politicians understand that, unfortunately, the average German in the street says and complains, says, I wish we were back to the Deutsche Mark. I wish we were not bailing out the Greeks and so on. And unfortunately, the politics within the Eurozone is becoming worse rather than becoming better. And unless there is going to be political leadership to realize that the Europeans are in this boat together, that either they swim together or sink together, the politics might actually make the provision of liquidity more difficult. And finally, after 2013, the current IMF programs and EFSF and ECB is supposed to be phased into this European stability mechanism, the ESM. But this ESM liquidity provision may not occur because the politics now is going against it. And even if the ESM were to be formed, it's not obvious that countries that are in trouble today are going to regain market access. They might not regain market access, one, because technically the claims of the ESMs are more senior than the claims of the EFSF or of the EU, and therefore, if somebody in the private sector wants to lend money to these countries, are not going to do so if their claims are subordinated to official claims that are becoming a larger part of the public debt. And secondly, the ESM implies a bail-in rule that says that money is not going to be provided to countries that have unsustainable debt problem. So no private credit is going to be willing to lend new money to countries that are in trouble if there is a situation in which their claims are going to be restructured. So unfortunately, in the case of Greece and Ireland, the sovereign spreads of this country, instead of falling, have been rising in spite of the official support, and they've reached now levels that are not going to regain essentially market access. So to conclude, I think that the experiment of the Eurozone is an important experiment, is one that actually has led to peace and stability and economic growth for most of Europe, and was an experiment worthwhile undertaking and worthwhile maintaining. But we should not put our head in the sand and not realize there are fundamental difficulties that all these countries have to address. First of all, the countries in trouble have to help themselves, but also the core of the Eurozone, that is the ECB, the EU Commission, the IMF, and the German, have to be part of the solution. At the end of the day, in order to maintain economic, social, and political support for tough austerity and reforms, you require economic growth, because no social or political body can accept pain unless there is light at the end of the tunnel. And the light at the end of the tunnel has to be that while I'm tightening my belt today, I accept sacrifices, fiscal austerity, higher taxes, less transfers, more reforms. There has to be growth of economies, return of economic growth, return to employment growth, rather than continued contraction. So I think that the key to the sustainability of all this program is going to be the question of whether we can restore economic growth in Portugal, in Greece, in Ireland, in the rest of the Eurozone. If that happens, then the system is going to stay together. Otherwise, it could be a situation that's becoming socially, politically, financially, and fiscally eventually unsustainable. I'm hopeful that the Europeans are going to think themselves as European, like they do in this country that was, as I said at the beginning of globalization, and everybody here feels that they are Portuguese, but also part of Europe. And those sacrifices here, together with the solidarity of the rest of Europe, is going to get you out of your problems. I'm hopeful that that's going to be the case, because this is a great country with a great tradition, great values, great entrepreneurship, and great opportunities actually to thrive in this global economy the way it did several hundred years ago. So on this hopeful note, hope that things are going to go in the right direction. And thanks very much for your interest and attention.
Thank you.